Good afternoon, everybody, and thank you very much for joining us. I'm Andy South. I'm the head of EMEA Structured Finance at Structured Finance Research, I should say, at S&P Global Ratings, and I'll be moderating this next panel session. Thanks also to the two Richards, who hopefully you just saw for their observations in that fireside chat, which I think was very interesting and a useful way to frame the discussion for this next session, where we're going to dive a bit deeper into sustainable finance, specifically with regard to European securitization. So we've called it, what does the future hold for sustainable securitization? So we're going to, without stealing our own thunder too much, we're going to be asking, where are we so far? What types of deals have we seen which were labeled as sustainable in some way? What should a sustainable securitization look like? The debate around that. What does all this mean for any extra disclosures that are going to be required? And then, how stakeholders such as investors and regulators are reacting to this new movement, if you like. Now, we have got, to get you more involved, we have got a couple of polling questions for the audience on the system, which hopefully you'll be able to see as we progress through the session. So let us know your opinion on those two questions, which will speak to something we're going to discuss with the panel at various points. So we'll look at the answers when the appropriate time comes. So without further ado, let me introduce my panel. First of all, we have Mira Lamrieben, who is a policy expert at the European Banking Authority. She's on the Capital Markets Union team, and there she's involved in implementation, or has been involved in the implementation of the EU securitization regulation, including work on significant risk transfer and the STS label, and is also now monitoring the developments in green bonds and sustainable securitizations, which is what brings us here today. Anna Back, next up, Associate Director in the Securitization Division of AFME, and she's responsible for developing positions of AFME and their members on a variety of securitization-related topics, and then representing those to the European institutions and various other national and international authorities. Andrew Lennox is a Senior Portfolio Manager at Federated Hermes. He's responsible for sourcing and structuring securitization allocations for the firm's multi-asset credit portfolios. And for those who don't know him, he has 20 plus years experience of financial services, and most of that's been as a structured finance portfolio manager at various buy-side institutions. So he's the voice of the investors, or a voice of the investors here today. And then finally, last but not least, Matt Mitchell, my colleague, director in the structured finance group at S&P Global Ratings. In his 10 years at S&P, he's worked on new issues and surveillance across numerous structured finance asset classes, and he now also leads our global efforts covering environmental, social, and governance factors in structured finance. So welcome to all of you, and let's kick off. So I wanted to start with a bit of a broader framing now, following the fireside chat regarding, where are we as we stand today, the story so far, if you like, for sustainable issuance in the European securitization market. So what have we seen so far? How much of it has there been? How developed is that versus other markets, such as financial unsecured, for example? And what are the different approaches we've seen or rationales to labeling something green or social? A lot of questions there in one, but Matt, perhaps you'd like to have a crack at that.
Sure. Thanks, Andy, and good afternoon, everyone. Really, the story in structured finance is it's lagged behind the other sectors. So you said relative to kind of the corporate unsecured space, even the covered bond space, structured finance really for the past 5 years has been playing catch up. We finally did start to see some more labeled issuance in 2021. So we've seen the first social labeled issuance go out. We've seen a few green labeled RMB issuances over the past, again, 4 or 5 years, as well as a CMBS deal last year. So that does raise the question, though, well, why haven't we seen the issuance? Clearly, there's been a lot of market interest in that. And I think one of the points that comes up that we're going to get to in this panel is the never-ending discussion about, or the debate about, well, we don't have the available collateral today. So one of the trends that we've seen to address that is the difference between, a collateral-only deal, where that backing the securitization itself would have some sort of environmental or social credential, versus a use of proceeds transaction, which is more, I'd say, closer to in the unsecured space, where the collateral itself may not have an ESG tilt to it. However, the issuer would commit to invest those proceeds in collateral that does meet those features. And finally, something that we've seen, I'd say, more it started in Australia, but we've had more and more discussions in Europe now, is on what we would call green tranches, or a hybrid approach, where maybe not all of the collateral backing the deal would meet environmental or social credentials. So only a portion of the deal would fall under that. And again, I think from a total benefit perspective, I think the strongest setup would be those structures where both the collateral backing the deal as well as the issuer committing to use those proceeds in some sort of environmental or social project. So again, issuance volumes right now in Europe, largely the RMBS space, where we have seen growth internationally actually, is in non-traditional assets. So looking to asset classes such as railcar in the US, we've seen solar transactions, some data center deals with energy efficiency in the way that they're producing through geothermic heating. That's a less developed market in Europe, but we are starting to have some more discussions now about the potential emergence of those asset classes. So maybe I'll leave it there and then leave it to Anna to pick up.
Yeah, Anna, did you have any thoughts on this sort of broader framing question?
Thank you, Andrew. Thank you, Matt. And again, hello, everyone. Yes, I very much agree with what Matt had said, but I think also what we've noticed, which is quite important, what's happening within securitization is, first of all, at the very beginning, everyone was focusing a lot on the environmental aspects. So we, of course, started with seeing green securitizations at first. I believe the first one that were actually around in Europe, it was the Green Storm series issued by the Dutch Obvion. But what the last year has brought, especially within the context of the pandemic, is that the shift from just looking at the environmental aspect towards the social aspects. The G part, the governance, has been always there because it's securitization has always been very well governed. So I think the G, in my opinion, the G aspect was always there. But we also see, as I said, a lot of shift from really looking at the just environmental aspects of transactions towards moving to sustainability and to the social aspects. And I think especially we've seen here within Europe, it was the UK who came up as a first sort of leader here in this market. Another thing which I would like to sort of make a point in a little bit like broader context is that we also have to look at securitization not on the sustainable security, not in a vacuum. So this is also a product that belongs to the whole, securitization belongs to the capital markets. So all sort of regulations that are affecting capital markets and other products are also looking at securitization. And I think at the very beginning of these discussions, I'm talking here about 2018, 2019, a lot of market participants were very much focusing on just looking specifically on securitization. Now I think we're seeing a little bit broader picture. So when we're thinking about sustainability in securitization, we need to now think about, EU Green Bond standard that is actually applicable to securitization. We need to look at the Sustainable Finance Disclosure Regulation, at the taxonomy. So this is whole, it's coming in a whole, in a whole kind of big context. And I think it is important to remember when we're talking about securitization and sustainability, at first, it has to belong with the whole rest of the similar product. And also, if it's a sustainable securitization, it's always a securitization, so it will be regulated by the securitization regulation. So I think those are the kind of the main two, let's say, high level points I'd like to make to start with. And I pause here to let my other colleagues speak.
Yeah, no, thanks for that. No, it's a very good point, of course, that that to the extent that the market existed a few years ago, it was around one particular program that we all know from the Netherlands with green collateral, and as you say, the social angle is what's really changed and come to the fore this year. And I suppose one of the challenges is that the more different green, or the broader the aspects that are considered to make something sustainable deal, then always the more challenging it kind of gets as to sort of what the definition is. And I mean, similarly in the covered bond space, in terms of looking at another area outside of securitization where the history is a bit longer, I guess with covered bonds, it's a bit more, it's a bit easier. It's to do with it's always about the collateral in the cover pool. Whereas in securitization, we have these broader questions around what counts, which is what we're going to come to next. But I think if Matt Jones's slides, which you may have seen earlier, or you may not have done, he had a list there of all the European deals that you've mentioned that have so far happened and been labelled as green or social. Because the other thing, and I mention this because it's on the poll that's on the screen, is this concept of sustainability linked deals, where in other words, neither the collateral is green nor the use of proceeds is green, but there may be just some other sort of environmental or social targets which the seller or the originator is going to meet within a time frame before, and if they don't, perhaps the coupon ratchets up. We haven't seen any of those, right, in the securitization space?
Not that I am aware of. I think that within the securitization space, we've seen obviously initially the RMBSs, and I think that was in Europe the kind of at the beginning strongest class. Also, as Matt said, we start seeing a little bit more towards the kind of asset classes that are developing. Of course, there's big hopes, and I think we're looking a lot towards the auto loans, which this is an asset class that has quite big potential to. Again, there is always a question here whether it should be, whether we should just look at the electric vehicles. I know there's a lot of discussions, and again, here we're coming into nitty-gritty details of, whether electric cars are the only one that are ecological, etc. But, aside of this discussion, I think as an asset class, we should look, but it's also important that I think as far as I'm aware, there was also a first ABCP transaction that was back in 2020, and I think it was Crédit Agricole who issued the first ABCP that was labeled as green. And I know there was also some of the synthetic transactions. They have been also linked to sustainability, or they have been labeled as green. So there is, I think, important thing to notice that the market is super tiny. I think, as we said at the beginning, especially comparing to other similar product, is a tiny market, and then within securitization is a small market, but it's growing.
Okay.
Yeah. And actually, Andy, to pick up on that, so this market does like to always be innovating, and we have actually seen the first sustainability-linked ratchet introduced in an ABS transaction now. It was a private deal for a rental fleet, but something that we would really expect to see more of going forward. We're seeing some of the underlying collateral in CLO portfolios, for example, also contain a ratchet feature now. So really would expect one of those trends over the next 12 months to be how we see, again, what has first evolved in the corporate space make its way into securitization products.
Yeah, and on that CLO point, that's interesting. We'll come back to that. I've got a question for Andrew on that. But thanks for that overview of the different things that have been labelled sustainable basically so far, and or could be in the future. I mean, I think moving that discussion on now, I want to ask Andrew. Basically, from an investor's perspective, which of these rationales that we've seen do you buy, if you like? I don't mean literally, but there's obviously a lot of debate around whether it has to be the collateral, or can it be the use of proceeds, or can it be something completely different, like a link to some sustainable goals that the originator might have, which is what the poll is about on the screen. It looks like the most popular response just so far in our audience is the broadest possible one, which is any of these types of rationale should be somehow considered sustainable. What are your thoughts on that?
Thanks. That's a pretty big question. I think the proliferation of ESG frameworks over recent years is being at such a pace that it's very difficult for anybody to keep up with. And it's for investors like us and that are running funds to choose which framework to follow and which rationale to follow. And I think, I'm taking the word of someone else on this because I have clearly not counted them up, but there's north of 200 ESG frameworks worldwide. So there's a huge amount to choose from. And standardization is required at some point in order that people currently who are feeling their way through this quandary can actually make some sense of it, and actually the standardization between jurisdictions and between investors and how people are approaching it. But at the moment, we do have framework arbitrage. So whether you're an issuer or whether you're a fund manager, you can pick the framework that works for you and call it ESG. Now, on the other side, we've started to see this. There's a backlash of greenwashing, and we've seen it not only from a deal point of view, but also from a fund manager point of view. You've got certain houses that have been accused of greenwashing their funds. I think one of the important things that we would like to point out is once you've picked your framework, you have to stick to that, and you have to be consistent with how you approach your investments, and you have to be clear with your investors as to what you're doing and why it is adhering to that framework. I think one of the other important things, and this goes back to the point that Anna made, we don't operate in a vacuum as a securitization market, and consistency with other asset classes is paramount. Within Federated Hermes, as you pointed out, Andy, at the top of the call, we run multi-asset credit funds where structured credit exists alongside investment grade and high yield credit. If we were to move any of these mandates to have any kind of sustainable impact or ESG label on them, we don't want to then be forced to divest structured credit out of those portfolios just because we can't align ourselves. So alignment is not only preferred, but I think it's necessary for a number of investors and how the securitization market is used. The use of proceeds versus collateral-backed securitizations, I think this is going to rumble on for some time. I think we have to, as a market, be somewhat practical and pragmatic about it at this stage. We're, as Matt mentioned, we're lagging behind. We've got to make a start somewhere. No one out there at the moment, as far as the originators are concerned, really has critical mass for collateral that can be classified as environmental, social. So we have to support their moves in some way. And a lot of people are talking about engagement, stewardship, etc. This is how we can support this. We can support transactions that are moving on the right trajectory, on the right path. And it's in the corporate world, in the high yield, in the leveraged loan market, they call it financing the transition. So moving from brown to green. And I think that's something that we can consider within the context of securitization. I think if you're looking at the use of proceeds where you're not looking at green or social collateral within the static pool itself, but you're looking at a use of proceeds, reporting becomes extremely important. And we could possibly spend the next 26 minutes of this session talking about data disclosure and transparency. But our market's been talking about data disclosure and transparency since the global financial crisis kicked us. So I think it shouldn't come as any surprise to any originator that investors are looking for more. So when you're talking about use of proceeds, there has to be a clearly defined set of parameters as to how those proceeds are going to be used. One of the great advantages of securitization is you can put a load of collateral into a pool, it's ring fenced, it's bankruptcy remote, you can have that defined whichever way you want. Similarly, that has to be applied to use of proceeds so that we can clearly see how the green proceeds that have been raised from a bond issue are being used. And I think that all comes down to trust with the originator themselves, trust with the servicer, and the disclosure that they're going to be putting out there over the course of years.
Okay, great. Thanks very much. And Mira, like from your perspective, how do you view this sort of problem or this debate around what should or shouldn't a sustainable securitization be?
Yes, so good afternoon, Andy. Good afternoon, everyone. So, I mean, if I may, I would like to depart a bit from this, well-known debate between, the asset-backed securities or the use of proceeds, definition of sustainable securitization. So we need to take a step back and highlight on the fact that, historically, ESG has been introduced, in the area of equity finance and corporate bonds. And for this instrument, it is rather, easy to understand what a sustainable bond is. You just look at the ESG credential of the asset side of the balance sheet of the insurer, or you looked at more broadly ESG KPI indicators of the insurers, and you can build your view on whether the bond is sustainable or not. Obviously, there's still data issues, but I think we know very well how this could work or should work in this area. In the area of structured finance in general and for securitization in particular, it is much more complex to define what a sustainable bond is due to the multiple parameters that may be considered. I mean, obviously, as you know, in a securitization, you can't have several parties involved in the transaction, from an original lender, originator, sponsor, servicer, monoline, and so on. So first of all, you will need to determine at which entity level or level the ESG requirement should apply or should be relevant. The second point is that, obviously, as you know, there's also a variety of underlying assets which can be securitized. And while defining green in the context of RMBS, CMBS, auto ABS is rather straightforward, this looks rather challenging for other asset classes, such as consumer ABS, and especially if the loans are not secured. And here, I'm afraid that while the EU taxonomy will obviously clarifying some points, the EU taxonomy will never be as detailed and specific enough to cover the wide spectrum of securitized assets. The third issue that was also mentioned is about the monitoring of the use of proceeds, which could be difficult in the area of securitization due to the remote nature of the SPE in the context of true sale securitization, and especially if the originator is not an original lender, but also in the case of green synthetic securitization, as it is also very complex to kind of see how the capital gain by the transaction was specifically used to finance a project, given that in this area of capital, the monies that you get are supposed to be fully fungible. And thirdly, I mean, although we have introduced some standardization with STS, but still in the area of securitization, I mean, all transactions could be very unique in the way they are structured. So I think this was mentioned by Matt in the introduction, but we have seen now, I mean, how the market is evolving with having ESG credential across all the transaction or only for a specific tranche of the transaction. From the deal that we saw in the market, we've seen that all of them were very unique also in the ESG, in their own ESG narratives. So there is really multiple way for securitization transaction to be sustainable, depending on how you combine different parameters. So, but also depending on whether you have a static or a dynamic portfolio, or whether you have a revolving transaction, the ESG credential of a securitization transaction could vary over time. So as a result of this, I have to say that although we can obviously agree on a kind of simple and broad definition of what a sustainable securitization is, and this will be very helpful in clarifying what are the core components that should be taken into account to identify what is a sustainable securitization. I think that this should only be seen really as a baseline, to define what is a sustainable securitization, and also here I'm afraid that this should not really reduce the amount of due diligence work that the investor would still have to do to ensure that this sustainable securitization still meets its own ESG internal policies and objectives.
Okay. Oh, yeah, no, I mean, thanks very much. I think, between you and Andrew in the last couple of, on that point, you've both raised many of the challenges. And I just wanted to talk like Anna, for example, we've said that there's all these different ways that a securitization can potentially be called sustainable. And obviously, but all of them have a burden, if you like, that then is how to prove that it's sustainable, either at the outset or on an ongoing basis, depending on which of those different sort of rationales are being used. I mean, and this is an industry, obviously, where we've been through over recent years a lot of, reporting requirements and disclosure requirements already anyway. What are your thoughts around how the industry manages that new challenge?
Yes, I think it's actually quite timely, this question. We had a discussion recently among our members, and we've been actually trying to discuss again the definition of the sustainability in securitization. And I think, regardless of different arguments for one way or another, the bottom line was that indeed here the disclosure and the due diligence becomes the kind of the key component. So in a way, whatever way you choose to whatever way you choose to go, whether it's a use of proceeds or whether you want to go through the way of green assets or sustainable assets in this case, it's the disclosure and the due diligence that seems to be really the core. And here, I think we already mentioned it, that securitization as a product went through a long process of a completely new regulation that introduced a very strict disclosure and transparency regulations. And honestly, I think securitization is the most regulated product in this kind of, in the capital markets, especially when it comes to disclosure and the data. And I think there is still a little bit of a discussion around, the availability of the data. And I think that's true mainly because some of the data that is linked to sustainability has never been sort of looked at before. So very often the data maybe is there, but it wasn't gathered yet. So I think this is one of the area where we still need to focus a little bit more. But the main sort of point I wanted to make when it comes to disclosures in securitization is that we should definitely use all the framework and the regulation that is already there, and there's quite a lot. So at AFME, our position is that we should use the framework that already exists, and only when it's necessary, it should be extended to maybe include some more disclosure, only when it's really necessary. But we would be very kind of far away from having a whole new regime, a whole new framework, just focusing on this new set of disclosures, specifically on securitization and sustainability. I think it's also the topic that will be probably discussed over the next months as we see the market is developing. I think we will also see then more data, more disclosures will be available. So I think that's also something that we need to think about.
Okay, great. And Matt, briefly, I don't know if you have anything to add to that from our perspective.
Yeah, and so picking up on Anna's point about, well, what will those disclosures look like, is that there's a lot of different industry groups right now trying to work on some sort of, I'd say, outside of regulation, kind of an industry-led solution to this, and with a global focus. So it's one, defining, so for each asset classes, what should those standards be? And one thing that we look at today, going back to Anna's initial comments about social securitizations, is a lot of times those data fields are much harder to naturally quantify than something on the environmental side of things. So what we've seen today with some of the second party opinions in place is it at a framework level or at a transaction level? And a lot of the times it's at a framework level today, which means you're not actually digging down into asset level information like historically we're all used to doing in structured finance. So I think right now the industry is trying to come up with, on more of a loan level basis, what should different metrics be across asset classes? And in that mentality of social securitizations, again, thinking to things such as an unsecured consumer lending deal, it's not necessarily just the borrower characteristics that matter. What are they using that credit for? And can you actually get your hands on that data? And that's a big challenge. Is even if you can define what you think those metrics should be, sometimes it just might not be able to be collected. You will not know necessarily what someone is using their credit card for, the proceeds from an unsecured loan. So that's a risk, I think, that some asset classes will face. The other is going to be if you see differentiation by country. So going to the green space today, we'll see that, well, there even are some standards in EPCs. However, the EPCs across Europe aren't measuring the same thing necessarily. So how do you come to one common approach such that you don't need to know 15 different taxonomies? Is there just one? So I think there will be a lot of development in this. Again, I know Anna and AFME have put together some research pieces already on what they think certain types of fields should be disclosed in a type of diligence questionnaire, because one of the biggest challenges that we're hearing from the issuer side of things is right now each investor has put together their own criteria. There isn't one standard. And so to be able to react and actually get valuable information throughout that marketing cycle of a deal is one of the obstacles today. And I'm sure Andrew will probably have something to weigh in on this side of things as well.
Yeah. Okay, thanks very much. I just in the interest of time, I think we've only got about 10 minutes left, and I did want to move on to Andrew actually, just to talk about, so far we've talked about principles, I guess, and sort of, idealistically what should something be labelled sustainable. I want to sort of turn to the economics of this in the long term. Like, clearly an issuer might hope that if they do a green deal or a social deal, that they're going to have to pay a bit less for that funding. As an investor, are you going to accept a lower coupon for that? Is there a green, in other words?
No one wants to get paid less. Everyone's talking about ESG, and most investors are claiming to have a focus on ESG when it comes to their investment processes. But within Federated Hermes, we are continuing to be surprised by those deals that are supported, that we view as having weak or no ESG credentials. So, for example, an auto deal that has a high percentage of diesel vehicles or a high percentage of secondhand cars or a high percentage of secondhand diesel cars, you would view that as being lower down the range on ESG as those deals that have newer cars, more efficient, polluting less. There's all sorts of considerations that come into play there. The environmental impact of creating a new car versus continuing to use another car in the terms of a second-hand car. We can balance all those factors out, but as things stand at the moment, deals that are, in our view, weaker from an ESG point of view continue to be supported. So I don't think we've seen the market move to only considering ESG in front of credit. There's clearly a strong technical for ESG assets, and this may result in a greenium, as it's been termed, and it may result in outperformance of those assets as the brown assets or the traditional assets get left behind. There's a weaker technical for them, but we're not there yet. There is still caution within the market, and no one wants to be accused of greenwashing. So no one's currently chasing those deals to the extent that they can pile into them, put them into a fund, call themselves ESG, say that they're Article 8 compliant, all of those things. No one's at that point yet. And no one, I think, is at the point yet where they're saying my structured credit fund or my multi-asset credit fund that incorporates structured credit can be considered this, that, the other. It's still very early days. And I think as a market, we're still focused on credit. And one of the things when it comes to pricing of these so-called green or social bonds, one of the things that investors still look at is credit first and foremost. And the question becomes, do these green mortgages or do these social mortgages perform better? Do borrowers of electric auto loans and leases on electric vehicles, do they perform better? Now, if you strip out the demographic effects of typically more affluent people have more energy efficient properties or newer properties, or they've made the improvements, or they may be the ones that can afford to drive a Tesla around, it's still too early to say, because stripping out those effects is quite difficult at this stage. And from the rating agency side, it's probably going to take 10, 15 years worth of data before you can truly change your models and back that up with historical performance data that you can rely on. So I think we're still at the early stage. There is that strong technical, which I think possibly contributes to a few basis points here and there. It doesn't necessarily mean that you've got a whole heap of investors more than you would normally. We have seen good subscription levels on those deals that have called themselves green and social, but I think we're still quite a cynical market when it comes to the labeling. And I think especially, and I think Matt's touched upon this, from a social point of view, quantifying what's a social RMBS versus what's not a social RMBS is very, very, very difficult. And if you look at the originators that have attached that label, it's difficult to discern what's different about their lending practices that are now considered social versus previously. And that's not to say that they're not social now. It's just to say that they probably always were social. It's just that because of the new frameworks and because of these new definitions that are constantly evolving, it becomes applicable, whereas before possibly wouldn't have been able to do that. I think on the point about margin ratchets, and you threatened to ask me about CLOs as well, we've started to see that obviously in the loans market. You see margin ratchets, and clearly this goes back to the financing the transition and supporting those operations that are making the improvements that we want to see in order that environmental and social goals are pursued. I think as any investor who's operating in this environment would agree, we want to support those deals. We clearly don't want to be paid less. That's not what we're in the market to do, but we do want to support this move. And I think that's something that we have to do. What the level of the margin ratchet needs to be in order for it to be meaningful, I don't think the market has come up with a conclusion there. The market clearing margin ratchet level hasn't been decided, but margin ratchets need to be meaningful. They need to reduce the cost of financing for that corporate or for the securitization when it reaches our market in any meaningful sort of way. But the margin ratchets also need to be meaningfully linked to meaningful targets. And by that, I mean meaningful improvements, whether it's on the social side, the environmental side, etc. Those targets need to be meaningful. And what we've seen so far is companies that put margin ratchets in their deals for targets that have already been met or largely been met. And so that hurdle to reach that target is not that difficult, but then they expect investors to support that and be paid less. So I think what we need to see is meaningful ratchets, but also meaningful targets.
Right. Yeah. Thanks very much. And actually, the polling question, which is on the screen there, it seemed that the vast majority of our audience did think that there is a. I'm back to the greenium now. There is a sort of. It's likely that sustainable deals will price tighter, but of course, to your point, that could be for reasons which are not just the technical. It could be the credit part of it as well. Okay, we are very nearly out of time, and I see we've got a question or two in as well. But Mira, I just wanted to very quickly ask you, and you have touched on it already, I think, but in your role as a regulator, what of all these sort of challenges that we've discussed around disclosure, around definitions, standardization, what do you think is your role, and going forward? How much a regulation is going to help versus the market's own sort of agreement, and I think you already spoke about to what extent existing frameworks like the taxonomy and so on can help with that. We only have a couple of minutes left, I'm afraid.
Yeah, so indeed. So, I mean, the EBA has been mandated by the EU co-legislator to assess, how we could establish a specific framework for sustainable securitization, taking into account the EU taxonomy, the SFDR requirement. And based on this report, the EU Commission will decide next year whether it would like to put forward a specific regulation for securitization product. I have to admit that this is a kind of rather complex work to deliver due to the fact that there are several key policy but also technical consideration that needs to be duly considered. First of all, to decide on whether or not such a framework would be relevant in addition to the EU Green Bond standards. And secondly, how this framework could be designed in such a way that it is credible, but also that is used by the market and that is also, helpful in this transition. So this is hard work because, as you know, the EU sustainable market, it's still at its infancy. We haven't seen a lot of these, and there's not a lot of experience gains in how the ESG factors are or could be implemented in the securitization world. So here there's basically a trade-off between having kind of regulatory guidance, but at the same time not risking limiting the ESG innovation in the area of securitization. The second issue is about a level playing field of treatment between securitization and other asset-backed securities. As to our knowledge, there is no yet specific framework or ESG requirement beyond disclosures that are applicable to other ESG financing instruments. So here we have to be really careful not to create a competitive disadvantage or complexity in the securitization segment, but also not to kind of create a potential inconsistency or precedent in the way sustainability could be defined for the type of product. Second issue, and I think this was already mentioned by Anna, is how we could integrate sustainability into the EU regulation, which is already very complete, to say it a bit differently than Anna. So we have already credit granting criteria, sustainability disclosure, due diligence, and so on. So to do this properly, we need to do a kind of ESG screening of existing provision to ensure that there's no duplication of rule and to make sure that we really add only the ones that are currently missing. And I think we all agree on that. And the fourth aspect is about the interaction between the STS regulation, the potential sustainable securitization framework. I think here there's a clear consensus that the two frameworks should be kept separated in a way that being STS should not be a precondition for being sustainable and vice versa. But at the same time, we know that there could be synergy in this framework, as also it mentioned, I mean, in securitization, but in STS specifically, we have a lot of criteria regarding governance, which could be very useful in the area of sustainable securitization. And also in STS, we also have this use of third-party verifiers and so on. So there's maybe something to be done in terms of streamlining the process to get the STS and sustainable label for securitization, which are thinking for the two labels. So here, I mean, against this background, what the regulation could do at this stage or could not do is to kind of build a fully fledged, framework for securitization product. I mean, we are definitely not yet there. So the objective is really to identify the key area for which we think that these are the ones that are really needed at this stage for the market to kick off in a kind of safe way, I would say, to put it very simply. And here we know that it's disclosure. So we need basically to duplicate the concept of PIA disclosure in the area of securitization, which is a new concept that doesn't exist yet in the area of securitization. We have the EU Green Bond Standards, which will be soon a legislation. So here we need to specify the extent to which the EU Green Bond Standard could be applicable to securitization and whether some adjustment would be needed or not. And as a last step, I think it would be nice also to have a global direction of travel of how this framework could be designed if the Commission, in a very broad term, if the Commission finally decide that there's a kind of a strong business case for having such a dedicated framework for securitization.
Okay, fantastic. Listen, thank you very much. I think, unfortunately, that is all we've got time for on this particular panel. And thanks to all our panelists, Mira, Anna, Andrew, and Matt, for doing such a good job at condensing their thoughts into a short space of time. I'm sure we could at least have done double or three times that. And thank you also to the audience for tuning in today. We're now going to have a short break in the agenda for this session. And then you'll be able to tune back in for the next panel. That starts at 3:20 UK time, and that's going to focus more on the credit risk aspect of ESG factors. So for now, well, hopefully we'll see you again at 3:20, but otherwise it's goodbye from us.